With the recent precipitous drop in the markets, the big question is when will things begin to recover? Well, this is an almost impossible question when looking at the fundamentals. Sometimes looking at the technicals can provide some sort of an answer. Now, joining us now for this is technical analyst Ron William from RW Advisory, who's in Singapore and joining us on the line. Ron, it's good to catch up with you again. We quite often speak in the studio, but I know you're busy there in Singapore. Before we get into your charts that illustrate your point, I wanted to open with a brief, broad question about what are the opportunities in this new environment that we've seen ourselves move into very swiftly in the last 3 or 4 weeks?
Well, I mean, what a strong start to the year, and of course, volatility is definitely here with the 30% crash we've seen in just a few weeks. And I think with that, the best answer I can say is learning to be calm in the eye of the storm. And so, for some of the short-term traders out there, being really just astute, fast enough, and on the trading side, but very much kind of focusing more on the risk and money management side, and right here and now, potentially catching that falling knife.
That, of course, is a very dangerous situation to be in, but nonetheless, something interesting to talk about. Let's bring up your first chart. I know we're talking here about the S&P 500. Now, this index we've been monitoring, and we've seen both limit down and limit up. So a lot of volatility in this. But let's take a look at this first chart and just talk us through what it is you're trying to illustrate here.
Yeah, so fortunately able to call the top back in both January 13 and 14th of Feb on the back of a double layer of exhaustion signals. I mean, many people have been looking for a top in the market for some time, including myself. But this is finally the pin that did burst the bubble, the coronavirus and many other things that took place. Of course, oil supply shock out of Saudi and really anything that can break the bull's back, which is what we have finally seen. And from that, the short position on my side was at 33.40 on the S&P 500. Only managed to get a marginal profit out of that just because of the volatility that you're actually speaking about. And actually, one thing I do want to mention is the liquidation patterns that we've been seeing precipitously in the last few weeks of this fall. You can see that just on the candle pattern basis. Every time we had a late intraday rally, it just got hit down to a new low breakout. And really, this is liquidation on the price pattern, but also we just read the headlines here. Some strong strategies are no longer working the way that they did before. And there's a lot of stories about mega hedge funds that are getting hit quite hard, ETFs that are reversed quite sharply. And as you mentioned, the limit down. So liquidity is becoming an issue. Tried and trusted strategies that have worked in the previous 10, 11-year cycle is now under real scrutiny and test. And so we're seeing some quite fast-moving markets at the moment. And right here and now, we're at the 2018 low. We've broken below it, but we're still hovering around it, around 23.47, and the intraday low at 22.81. I saw the futures also push down lower into our session today.
Yeah, I just want to talk about the point at which we're at the moment and your thoughts on potential downside from this point. If we get a healthy close below that level you point out there, where do we go? What's the story there on?
Well, one step before that is maybe potential rebound that will likely happen based upon the kind of oversold nature in the market, possibly into the start of April. That happens to coincide with some of the short-term projections for a peak in the coronavirus cases. Of course, that's a moving goalpost that is a real unknown. But if it does coincide with the timing cycles, then it would create a very strong cushion in the market for a rebound, doubling up with some of the additional central bank intervention that will likely continue. But from the price basis, if we do see any oversold rebound in the short term, the key levels are 26.45, 28.35, and the 3,000 psychological level, which is near a few confidence levels. Now, I've been very diligent on these price levels because, of course, if the market were to break down lower, it's really important to pick levels that will still be the same levels in the fast-moving market. So these are the key levels either to buy into for a short-term tactical long opportunity, or to maybe sell into for the bigger move down, which I do believe will likely happen.
Well, let's look at that in terms of your second chart and take a look at the longer term picture, because you were right there to point out the individual candles, and we can do this because of this sudden and tremendous drop that we've had. It's almost on a daily basis. You've seen these daily candles that develop. But on the longer term picture, let's take a look at the second chart.
Yes, well, a picture speaks 1,000 words, especially when it has enough history in it to really add context to the big cliff drop move that we've seen. Again, just to remind, 30% in just a few weeks. Now, if you look at it on a long-term basis, you can see that it's. I mean, this is a chart going back to the 1980s. A lot of people have been talking about the 1987 price analog, which I'll allude to in a moment. But if you actually draw a trend regression measure from the 87 low and predict it up to right now, we're actually testing the mean of that kind of 30-year level line in the sand. We're clipping below it, but we really are likely to hold around that, or around what I call the breakout level at around just below 2,400, a breakout level of a further 30% to come. So that won't be a straight line move that has to happen now, but that's certainly a high risk scenario that is on my radar. And let's look at the psychology of the market. We had an overextension outside of this 30-year channel. That's a +1 standard deviation on the historical measure, and what we call a bull trap exhaustion signal, or some people call it a throwover signal. That just shows that a lot of long positions got squeezed, and that then flips the opposite direction. So that mean level around 2,400 and change will be key, and also sets up a breakout of a mega double top pattern, which would push down to the Y2K peak levels and 2008 levels. So what was once a top could now be a big support level, 30% down lower.
Okay, well, the next question is, how does this represent itself within the even longer term picture and some of the well-known market crashes or certain hefty corrections that we've seen?
Yes, well, I mean, a look on the next chart just shows what I've always kind of deemed as a really must-watch chart. It has 100 years of historical data, and this was once taught to me by several kind of veteran mentors in the industry who spoke to me about generational long-term moves in the market. And we really need to think of this both in price terms, but also in terms of valuation. So bull and bear markets, bull markets, of course, with strong valuations, and bear markets with contracting valuation. And these are generational cycles, so they last on often for 16 to 20 years. Now, most of the time, we'll ignore this type of chart because it's not going to affect our day-to-day trading. But right here, right now, I really urge people to be watching this chart because it really adds so much context. The old phrase, the rising tide that lifts all boats, is now going the opposite way. That wave is actually crushing the boats as we speak. And you can see there's a 90-year trend regression, which we've broken below on this chart, looking to push down even lower to the bottom of the channel. But more specifically, we can see how cycles shift from bull to bear, and how the current cycle is timing in with asymmetric risk into 2020 this year, and the next 2 to 3 years as a minimum repair period for this bear. So bear markets aren't just about price corrections, they're also about the amount of time that is required for the repair to take place.
Let's bring it all together and talk about some comparison charts and how you've got the compare and contrast between different charts on the same picture.
Yes, I mean, this seems to be the big kind of market game at the moment. You know, spot the price analog and compare and contrast, and it's a good reference to practice to be doing. But be warned, if we pick the wrong picture and match it up with the current state of play, it can really kind of it can be quite difficult to trade, and develop a lot of behavioral biases that we really want to avoid. So the popular headline comparison seems to be the 87 crash in price terms. Of course, 87 was more a financial market crash and it was very short lived. But I think the main reason why most market pundits are choosing this as an analog is just because of the price and time match. So if you can see there on the chart, figure 2, 1987 had a three-stage process, which is usually the way bear markets play: a fall, rally, then followed by the rest of the fall. But that move was 40% in just 4 weeks. And of course, if we look at what's happened of late, it has been a 30% drop in just 4 weeks. So there's a little bit of a mirror image in terms of price and time. The big issue here, and the one reason why I really disagree with this from a technical perspective, is that the 87 correction was mid-stage in a long-term 18-year bull market. We are not mid-stage in an 18-year bull market. We are at the end of a very overextended, record-breaking bull market. And so whatever the pin that would have taken place to burst this bubble, whether it's coronavirus or whether it's any other event trigger, ultimately this is a whole new cycle that we're entering from bull to bear. And so the better examples would be all the other charts here, figure 3, 4, 5, and 6. So the GFC, the tech bubble, 1974, in some ways it could be similar, but not from a technical perspective, because it was a very different structure in the market. Remember, I'm talking just about price structure here, less about the macro and all the various event risks out there. And then, of course, the be-all end-all that we don't like to talk about, the 1929 Wall Street crash, which actually did make the headlines this time around, because the crash that we saw this time, 2020, was actually faster than the early stage crash of 1929. So I just want to highlight that. If you look at figure 6, you can see the initial fall in the 1929 crash was only 2 months. It was down 49% in 2 months and then rebounded by 51% before it had the rest of the fall, 86% and change. So remember, the pattern is a three-stage process, not an event: fall, rally, rest of fall. And then if we look at figure 3 and 4, which is your traditional bear cycle repair period, it's roughly between anything from 1.5 years to about 3 years. And you can see the tech bubble was actually twice the cycle duration as the GFC. Either way, these are just technical measures I'm throwing out in the air just for reference. We have to look at the nature and the character of this market. And of course, we're in the biggest debt bubble, I think, known in human history. And that party doesn't end well. So we have to at least assume a shakeout period that will take several years to repair.
Okay, then let's step back and just ask the main question. What's your best case and guess that you are looking at in terms of what we've learned in the past as to how things could develop from this point?
So certainly a three-stage process. Stage 1 is already in. We're down 30%. We're likely to get a rebound at some point, in the near term. My best estimate is in early April, we start to kind of hit that price and time sweet spot for a potential rebound. The rebound is likely to be very strong, so that can be traded on the upside or could be a potential new short position. But let's keep in mind that's likely to be the suckers rally. So everyone that does get sucked into that can make money for some of the time, but it will be the tidal wave that then slams back down onto the third level. Remember, it's a three-stage process: rally, a fall, followed by a rally, which is what we're talking about, stage 2, and then the rest of the falls. So we really need to make sure that we're fast moving. And maybe this is not the market all the time. Maybe we need to look at cross market, look at the dollar, which has been firing up and looking very strong at the moment. So maybe there are other opportunities that we should be looking at for the interim, just to have a better risk reward payoff.
Okay, look, Ron, we'll leave it there, but thanks indeed for joining us. Your thoughts on where things are at the moment and where they're likely to go. I'm sure we'll speak again in the very near future, and we'll get an update from you on your current thinking. But in the meantime, thanks for joining us. That's Ron William from RW Advisory.